Okay, I'd like to introduce Tripp VanderWal is doing our webinar today. I'd like to thank everybody for participating. He's from Miller Johnson, and he specializes in employer compliance, ACA laws, benefit law, COBRA, et cetera, stuff like that. Obviously, with the ACA, it's had a lot of taxes and fees to companies like you who already were taking care of their employees and doing the right stuff anyway. But now there's actually even more than that. There's a lot of new reporting things that you have to do. So we've asked Tripp to do the webinar for this. And the webinar should last about an hour, and then take some questions after that if you got questions. And then, we're always available to help you pull the things together. So I'd like to introduce Tripp at this time.
Thank you, Jim. All right, welcome everybody. Good afternoon and happy Friday. As Jim said, my name is Tripp VanderWal, and we are going to be covering some ACA reporting requirements. So here are a couple of the a couple of the housekeeping issues. You guys are all in listen-only mode right now. However, I understand that you have the ability to submit questions on over the computer. So questions may be submitted via the chat feature on your dashboard. As Jim said, our presentation is going to last about an hour today, and then we have allocated a half hour for questions at the end. There are only 8 people. Oh, and slides are going to be made available after the webinar, as well as this is being recorded, and you will have the opportunity to view it later if you should want to. There are only 8 of you on the webinar today, so please feel free to take advantage of the question and answer period. With only 8, we can probably get through a number of your questions. This webinar, because it is only an hour, is kind of a high-level review. We cannot go through line by line of these reporting forms, but we are going to address them in a more macro type environment. Last, this webinar does assume that most of you have some working knowledge of the pay or play penalty as that applies to large employers. Now that we have covered all of these housekeeping items, we will get started. So, as many of you are probably aware, the individual mandate, which is the obligation that the obligation that individuals have health insurance, took effect in 2014. The employer pay or play penalty took effect in 2015, and that is obviously the requirement that large employers offer their full-time employees health insurance or pay a penalty. Now, beginning in 2016, the IRS are going to require employers to do certain reporting in order to enforce these penalties. Back in March of 2014, the IRS issued final regulations on these reporting requirements that are required under the Affordable Care Act. The regulations were very helpful, but they left a lot to be desired because they were just a listing of information that needed to be required. In July of 2014, the IRS released draft reporting forms. So we actually got to see the reporting forms themselves and what they were going to look like and how this information is going to be reported. In August of 2014, they released draft instructions, which were very helpful. And 2015, the IRS released final versions of the reporting forms and instructions. Now, let me highlight something right now. The reporting requirements for 2014 were optional, and the forms that were issued in February 2015 relate to the optional reporting in 2015 that would have had to have been completed in the first quarter of 2016. Just last week, Friday, or it may have even been this past Monday, the IRS released draft forms and instructions for reporting purposes in 2015, and those are the forms that will be filed in 2016. The good news is they are largely the same as the reporting forms for the 2014 calendar year. So if you are familiar with those forms, not much has changed. There are 2 types of reporting that will be required, and they fall under different sections of the Internal Revenue Code. The first is Section 6055 reporting, which we also refer to as individual mandate reporting. And the second is Section 6056 reporting, which we refer to as pay or play reporting. Section 6055 reporting requires employers and certain entities to report to the IRS and responsible individuals whether their coverage that they're enrolled in constitutes minimum essential coverage. Because if an individual is enrolled in coverage that is minimum essential coverage, that individual is not subject to the individual mandate penalty under healthcare reform. So this reporting requirement under Section 6055 is intended to assist the IRS enforce this individual mandate penalty. Again, all individuals except for with certain exceptions must be enrolled in minimum essential coverage, or they have to pay a pay or play penalty. Now, the Section 6055 reporting applies to all employer group health plans regardless of the employer's size, which, as we will discuss, is a little bit different than the Section 6056 reporting. And there's no exceptions to this requirement. Now, having said that, you as the employer may not be obligated to comply with Section 6055 because of the allocation of this obligation. So as you can see on this slide, the Section 6055 reporting, for those of you that sponsor fully insured group health plans, the insurance company, the insurance carrier, is required to report on your behalf. Now, if you are on the line and your organization sponsors a self-funded health plan, you, the employer, as essentially the provider of coverage, will have to comply with the Section 6055 reporting. There is no insurer that's going to do it, and the TPA is not required to do it for you. The Section 6055 reporting applies on a calendar year basis, and that is true regardless of whether you have a health plan that operates on a period other than a calendar year. So how are we going to do the Section 6055 reporting? They will be accomplished by two forms, which are the 1094B and the 1095B. We refer to these as the B series forms, and we are not going to spend a whole lot of time on these forms because I don't think it's going to be very applicable for most employers. As we will talk about, it's really only going to be applicable to employers that are not large employers subject to the pay or play penalty, but also sponsor a self-funded plan. So again, that's may not be anybody on the line. But it is important to take a step back and to compare this reporting mechanism to a mechanism that many of you are probably familiar with. The way that the B series forms are constructed are very similar to the forms W-2 and W-3. So as many of you know, and many of you probably get a form W-2 from your employer every year reporting the compensation that you made in the previous year. Well, not only does your employer have an obligation to provide you with the W-2, it has to file it with the government. And when it files all of its W-2s with the government, on top of those series of W-2s, it files a form W-3, which is what is referred to as a transmittal form. If we think about this, it's really like a tax cover page or fax cover page, and it says, here's who I am as the employer, here's what I'm filing, and here's how many they are. The mechanism of the B series forms is very similar to that. The 1094B is a transmittal form, which will be filed to the IRS along with the employee statements, which are the 1095B, and require certain identifying information about the entity that's filing them. The 1095B, on the other hand, is the employee statement, and those are the forms that will be provided to the responsible individual and then a copy to the IRS. The 1095B has a series of information that's required. So it requires information about the provider of the minimum essential coverage. So for example, in a fully insured arrangement, the insurer is the provider of the coverage, where in a self-funded arrangement, this is the employer. It also requires information about the responsible individual, which is essentially the policyholder or the primary insured. So if we think of this in the group health plan context, the responsible individual is the employee that is enrolled in coverage. It also requires information about each covered individual. So those are dependents and spouses. And requires the Social Security number of the primary insured, again, that's the employee, and each enrolled dependent. Now, if you can't get the Social Security number or you don't have it, you can use the date of birth. As you can see, the slide says the date of birth is permissible if the Social Security number is available after reasonable efforts. So the question is, what is a reasonable effort? And the IRS has basically given us a 3 strikes and you're out rule. You have to ask the employee for the Social Security numbers of himself or herself and their enrolled in dependents when they first enroll in coverage. If they refuse to give it to you, when the coverage is renewed at the next annual open enrollment, you should ask again. If they again refuse to give it to you, you should ask one more time at the next annual open enrollment period. And if they refuse again, you can use the date of birth indefinitely. Now, while you're going through these series of asking your employees questions and they're refusing to give it to you, you can use the date of birth in the meantime as well. But again, it's basically a 3 strikes, you're out rule. If you ask 3 times and they don't give it to you, you don't have to ask that particular employee again. Here is a screenshot of the Form 1095B. Again, this is the employee statement that will be provided to responsible individuals. I did not put a screenshot of the 1094B because it's really a simple form and can be filled out with no instruction. As you can see, Part 1 requires information about the responsible individual or policyholder. Again, that's your employee who enrolled in coverage. Part 2 is information about employer-sponsored coverage. So that's information about the employer. And Part 3 is the issuer provider of coverage. So that will be the insurance company in a fully insured arrangement and the employer in a self-funded arrangement. Part 4 is where you're going to list the employee and all of the covered dependents. And you will indicate by the series of boxes which months of the calendar year the employee had coverage for at least one day of the month. Now let me give you an example. For 2015, I was enrolled in coverage, my wife was enrolled in coverage through Miller Johnson, and my infant son was enrolled in coverage for the entire year. So Miller Johnson, if it had to prepare this form for me, could check all 12 months rather than checking January, February, and each individual month. They can check the covered all 12 months. However, if you have an employee, a dependent, or a spouse that wasn't covered all 12 months, they can't check that box, and they have to do it month by month based on any month the employee or the individual is covered for one day. So a situation where this could arise, for example, is if the employee has a son or daughter that is born during the year and becomes enrolled mid-year. Section 6055, as I said before, is required on a calendar year basis, and that's true regardless of the fiscal period that your health plan operates on. And this slide just covers the deadlines of when these forms need to be distributed. So the 1095B, again, like a W-2, has to be distributed to employees or the responsible individual on the first business day on or after January 31 of the year following the calendar year which coverage is provided. So let me back up. If we're reporting for the 2015 calendar year, the 1095B for the 2015 calendar year has to be provided to the responsible individual on or after the first business day on or after January 31 of 2016. Now the Forms 1094B, which is that transmittal form and copies of all the employee statements, the 1095B, must be filed to the IRS on the first business day on or after February 28 of the following calendar year. If you are going to file them electronically, you have an extension until March 31. And if you are an organization that will be filing 250 or more Form 1095Bs, you are required to file them electronically. You do not have the option. So here is an example based on coverage provided in 2015, which is the first year that this reporting is required. The Form 1095Bs must be provided to your responsible individuals, which are your employees, by February 1, 2016, because January 31 is a Sunday. The Forms 1094B and 1095B must be filed in paper with the IRS by February 29, 2016, which is interesting because 2016 is a leap year and February 28 happens to fall on a Sunday. Now, if you are reporting these, or if you are filing these forms with the IRS electronically, you have until March 31, 2016, which is a regular business day. So there's no short little extensions after March 31. Now, just a few particulars to talk about with respect to Section 6055 reporting. If you are an organization that is within a controlled group which is, for as easy as I can put this, is a series of multiple companies that are commonly owned, then you have to do this reporting on an entity-by-entity basis. You don't do it for all of the organizations commonly owned on a consolidated basis. So, for example, if you have two organizations that are in the same control group, Organization A and Organization B, Organization A has to comply with this reporting requirement independent of Organization B. Now, if, for example, Organization A is the bigger one that has the back office, they certainly can prepare these forms for Organization B, but will have to do so on their behalf and fill it out with Organization B's information. You may engage third parties to assist you complete Section 6055 reporting, but as we'll talk about and a little bit later in this presentation, there are penalties associated with failures to accurately report or failures to report at all. And if you engage in a third party and they mess something up, those reporting penalties will still be imposed on you because you are obligated to do it. They will not transfer over automatically to your third party. Now, in your service agreement with your third party, you can arrange for indemnification that essentially says if these penalties are imposed, the third party, and it's the third party's fault, they will indemnify you for any losses. And the last point on the slide says most self-funded plans, again, the employer then is obligated to comply with Section 6055, will be reported along with the Section 6056, which we will talk about momentarily. So, what is the Section 6056 reporting? The Section 6056 reporting only refers to what the IRS calls an applicable large employer. And those are employers with 50 or more full-time and full-time equivalent employees. Essentially, these are the employers that are subject to the pay or play penalty. So if you are an employer that's on the call that's not subject to the pay or play penalty, you have no obligation to comply with the Section 6056 reporting. The purpose of the Section 6056 reporting, that's kind of a tongue twister, I apologize, is really twofold. It's one, to help the IRS enforce the pay or play penalty, and two, it is intended to help full-time employees and the IRS determine whether individuals are eligible for a premium tax credit if they go to an exchange and buy health insurance through the exchange. Again, Section 6056 is not required with respect to group health plans that are sponsored by small employers not subject to the pay or play penalty. For those of you on the call that are a mid-size employer, those are employers between 50 and 99 full-time and full-time equivalent employees, you may remember you got a little bit of extra relief from this pay or play penalty. When the final regulations on the pay or play penalty were issued in February of 2015, these mid-size employers were not required to comply with this penalty until the first day of their 2016 calendar year. So, for example, if you run a calendar year that operates on a December 1 through November 30 basis, you won't have to comply with this penalty provisions until December 1, 2016. But one of the requirements is you need to certify to the IRS that you met the requirements for the mid-size employer relief. The way that you certify this to the IRS is by filing these forms required under Section 6056. So even though you don't have to comply in 2015 with the pay or play penalty, you still unfortunately have to comply with these reporting requirements. So that's kind of the good news and the bad news all at once. Section 6056 reporting applies on a calendar year basis, again, like the Section 6055, regardless of whether your health plan operates on a calendar year basis. However, if you do operate on a non-calendar year basis and you qualified for the non-calendar year transition relief, you can report, and you'll see how we do this on the forms in a little bit, that you offered minimum essential coverage, that's what MEC stands for, before the 2015 plan year starts in Form 1094C Part 3, 1094C Part 3. And again, pictures of these forms will be coming up. So let's take a step back and go over who is required to file what forms and what forms they are required to file. So if you are not a large employer and you sponsor a fully insured plan, guess what? You have no reporting obligations. You have no reporting obligations under Section 6056 because you're not a large employer. You do have an obligation to file under Section 6055, but because you're a fully insured plan, the carrier is going to do that for you. Now, if you are a large employer that sponsors a fully insured plan, you have to file under Section 6056 because you are a large employer. You also have to file under Section 6055, but because you sponsor a fully insured plan, the carrier will do that for you. If you are not a large employer but sponsor a self-funded plan, then you do not have to file with under Section 6056 because you're not a large employer, but you do need to file under Section 6055. And you, as the employer, will actually have to do that because you sponsor a self-funded plan. There is no carrier to do that for you. And last, if you are a large employer with a self-funded plan, you have to file under Section 6055 and Section 6056, but you get to do so on a consolidated basis. You don't have to file the C-Series forms and the B-Series forms. As you can see on the slide, the Section 6056 is reported using the C-Series forms, which we will talk about next. Again, the reporting for under Section 6056 is done on forms 1094C and 1095C. And this mechanism, again, is very similar to the B series forms, which we already talked about, and the W2, W3 arrangement. So the 1094C is a transmittal form that will be filed with the IRS along with the employee statements. The employee statements is the 1095C. And here is a summary of the information that is required on the 1094C. Unfortunately, unlike the W3 and the 1094B, this transmittal form is kind of a transmittal form on steroids because it requires a lot of information. As you can see, Part 1 requires identifying information about the employer who's submitting the forms. Part 2 talks about whether or not it is an authoritative transmittal. Generally, the answer to this question is yes, and we will discuss this. Number 3 is information, or also whether employer is part of a controlled group of entities, and whether the employer qualifies for certain transition relief from the pay or play penalty, or qualifies for certain alternative simplified reporting, which we will discuss towards the end of this presentation. Part 3 requires information about what months the employer offered minimum essential coverage, the number of full-time employees in each month, the total number of employees in each month, again, whether the employer is part of a controlled group of entities in each calendar month, and last, whether the employee qualifies for certain transitional relief under the pay or play penalty in each calendar month. And if you are in a controlled group, you unfortunately have to complete Part 4 and list the names and EINs of each entity that is in your controlled group up to 30. If you have more than 30 entities in your controlled group, you only list the top 30 by size, and when we look at size, we determine size by the number of full-time employees employed by that entity. Here is a picture of page 1 of the 1094C, and we're going to walk through this kind of part by part. As you can see, Part 1, we won't spend much time on that because that is just identifying information about your employer entity. Boxes 9 through 16 are only apply to governmental entities. If I don't believe I have any governmental entities on the line, if I do so, we can certainly talk about this individually, but I'm not going to spend any time on that. Moving into Part 2, this is where we get into the meat of the reporting. So question 19 says, is this an authoritative transmittal for this ALE member? If yes, check the box yes. Again, this will generally be answered in the affirmative. You will generally be checking this box. But here's what the IRS is getting at when they ask this question. The regulations permit employers to file multiple 1094Cs within the organization rather than just one. And you're probably thinking, why in the world would I ever want to do that? And generally, I don't think you will, but here is probably the best organization. Let's say I have one company, not multiple organizations, one company, and I produce two different projects or products. I produce widgets and I produce sprockets. My employees who make widgets always make widgets, and my employees who make sprockets always make sprockets. And I have to report on both of these employees. If it is administratively easier for me to report separately for the employees that make widgets and separately for the employees that make sprockets, I can do so. I can file all of their 1095-Cs, and I can file them separately with two 1094-Cs. Now, the additional requirement, if you do that, is you have to file yet a third 1094-C, which aggregates the information between both 1094-Cs, and then that would be marked as the authoritative transmittal. Another good example is Miller Johnson, for example, is one company with a Kalamazoo office and a Grand Rapids office. Miller Johnson, if they chose, could file a 1094-C attached with all the 1095-Cs of the employees in Grand Rapids. They could do the same with a separate 1094-C reporting all of the employees in Kalamazoo. They would have to file a third 1094-C that aggregated the data. Now, why am I spending so much time talking about this if you're not likely to do it? Here is the key point. If you file just one 1094-C, that is the authoritative transmittal. You need to check that box. If you don't, the IRS computers will automatically reject your filing. So that box will have to be checked even if you file only one 1094-C. As you can see, box 21 says, is the ALE a member of an aggregated ALE group? In other words, that is asking if you are part of a controlled group. If you are, check yes, and it says, and if you're not, you can check no. And as you can see, it says if you check no, do not complete part 4. Line 22 says certifications of eligibility. And please note, a question that I frequently get is, will more of these apply, more than just one apply? And the answer to that question is yes. You do not have to check any boxes on this form, or you could check more than one. It's not a one-for-all type arrangement. You can see boxes A, B, and D, D as in dog, talk about different offer methods. Those relate to what we refer to, what the IRS refers to as simplified reporting. And we're going to discuss that simplified reporting towards the end of this presentation. But please note that box C says Section 49080H transition relief. Section 49080H is the Internal Revenue Code section that the pay or play penalty falls under. And if you are eligible for certain relief from that pay or play penalty, you have to check, or you should check that box. However, it only applies to two different forms of relief. The first one is if you are a mid-size employer. If you are a mid-size employer that is not subject to this pay or play penalty until the first day of your 2016 plan year, you need to check that box. That is what certifies to the IRS that you are eligible for that mid-size employer relief. The other reason that you would check that box is if you are a large employer with 100 or more full-time and full-time equivalent employees, and you decide that I am going to get out of the healthcare game, I'm not going to worry about it, I'd rather pay the penalty. As most of you may know, in 2015, when you go to calculate your penalty, which is $2,000 times all of your full-time employees, if you're getting out of the game, you get to reduce your full-time employee count by 80 instead of 30. And if you want the IRS to calculate that penalty, subtracting the first 80 full-time employees, you need to check that box. Otherwise, it will calculate the penalty only subtracting the first 30. And that's only checking that box is only step one. You'll see there's another requirement that will apply on the next page. Let me, another one little housekeeping item. I apologize. I do not love the webinar format because I love to engage with the audience, and as you guys have questions, I love to answer them as we're going. I find that's much more beneficial than saving them till the end. But this format just does not allow for that type of employee presenter engagement. Anyway, moving on. Now we are on page 2 of the 1094C. You will see that column A says minimum essential coverage offer indicator. You will check the box yes in each month that you offered substantially all of your full-time employees coverage that is constitutes minimum essential coverage. And basically any group health plan is an offer of minimum essential coverage. Now, what does substantially all mean? In 2016 and after, it means you offered at least 95% of your full-time employees minimum essential coverage. In 2015, so report this first round of reporting, it means 70%. So if you offered at least 70% in 2015 of your full-time employees coverage that is minimum essential coverage, you could check yes, or you should check yes. Now, typically, I would imagine you will check yes in the all 12 months box, but if you didn't, for example, in certain months, you would have to go through month by month. But column B says full-time employee count for an ALE member. That is where you're going to enter your number of full-time employees. You will see they have shaded out in the top all 12 months. I believe in the final forms for 2016 that has become an option. However, your full-time employees is highly unlikely will remain the exact same in each month. Column C is your total number of employees in each month, and there are methods in how you count those. You can either use the first day of each month, the last day of each month, the first day of the first payroll of each month, or the last day of each payroll, or the last day of the first payroll period of each month. And just as a side note, we are not sure why the IRS is requiring this information. They absolutely do not need it to administer this penalty. We suspect that if you report that you have 10 full-time employees, but you have 33,000 total employees, the IRS, that may trigger the IRS, and we may determine that they need to come audit to see if everything is done proper. Column D is aggregated group indicator code. So if you checked that you were in a controlled group on the first page of this form, you would indicate which months you are actually in a controlled group. Generally, I think that will be all 12. And column E, again, says Section 49080H Transition Relief Indicator. If you checked box C on the previous page, you have to complete this column. If you are a mid-size employer and you are relying on that relief, you need to complete this column by inserting the letter A as in apple. Now, if you are a large employer that has over 100 full-time and full-time equivalent employees, and you are relying on this 80 full-time employee exemption when they calculate your penalty because you have gotten out of the healthcare game, you enter in B as in boy. And let me just kind of explain how this form would work in calculating that penalty. If I'm an employer that has gotten out of the healthcare game, I'm going to say I obviously have not offered minimum essential coverage to substantially all of my full-time employees. So I will check the no box in column A. I will then have to list the number of my full-time employees in column B. The IRS will essentially take the number in each one of those months and multiply it by 1/12 of the $2,000 penalty after they subtract 30. But if they go over and see that you've marked in their B, they will subtract the first 80 full-time employees and then do that calculation. It seems a little ridiculous that we have to ask for that penalty relief, and why any employer wouldn't do it if they were in that situation, but that it is what it is. This is the last page of the Form 1094C, and requires, again, only applies if you are in a controlled group, and then you will list the other entities within your control group. You see that you have to list their name and their EIN. And the way that you order these is in decreasing order by size. So if you have multiple entities, you will list the largest entity first, the smallest entity last. And the way that we determine size is based on the number of full-time employees in that organization. Moving on, the Form 1095C again, is like the W-2. It's the employee statement that will be provided to each full-time employee, and a copy will be provided to the IRS. Again, these forms are only provided to any individual that was a full-time employee in any calendar month. Here is a summary of the information required. You can see identifying information about the full-time employee, identifying information about the employer, information about the employer's offer of coverage, the amount of the employee's share of the lowest cost monthly premium for self-only coverage that constitutes minimum value, and then an indicator code that will be used to indicate if the individual was enrolled in coverage or not. In Part 3, will only be filed by those of you that sponsor a self-funded plan. And this is essentially it looks exactly like the Form 1095B, and you will indicate which months the employee and his or her dependents were enrolled in coverage for at least one day of the calendar month. And you can see the top note here says non-employees that are enrolled in a self-funded employer's health plan may either be issued a 1095B or a Form 1095C. And who are these non-employees that may be enrolled in your plan? Well, if you provide retiree coverage, it may apply to them, or more than likely it will apply to individuals that are enrolled through COBRA. Also, again, the second note says if you have a fully insured plan, you get to skip Part 3. Here is a screenshot of the Form 1095C. As you can see, it looks fairly easy to complete, but if you start to think about the information that has to go in there, it becomes quite daunting. So Part 1 has information about the employee, Part 2 has information about the employer, Part 1 information about the employee and employer, and Part 2 has information that's required about whether you offered your employee coverage. So as an example, let's say you filed this on behalf of a full-time employee that you offered coverage to for the entire year. In the all 12 months column of line 14, and let me take a step back, that offer of coverage was made to the employee's spouse, and employee's dependent. In the all 12 months column of line 14, you could enter in 1E as in Edward, and that would apply for all 12 months. And that code means that I have offered this full-time employee, his spouse, and his dependent's coverage. Moving down to line 15, regardless of what coverage tier the employee enrolled in, if they enrolled in employee plus one or employee or family coverage, you will indicate what is the cost of single-only coverage for that employee. So again, let me reiterate, my family has enrolled in family coverage through Miller Johnson. However, Miller Johnson will report on my 1095C the cost that I would have had to pay if I enrolled in single coverage. Line 16 is going to indicate whether whether that employee enrolled in coverage. If they did enroll in coverage, you will report 2C as in Charlie. Now, if the employee didn't enroll in coverage, you're going to have to tell the government why there's no penalty associated with you. And that's where you're going to indicate that the coverage was affordable and that the employee just waived coverage. As many of you know, there are 3 affordability safe harbors. There's the rate of pay, the W-2, and the federal poverty line safe harbor. Whatever safe harbor your organization has chosen to use, you will indicate for people that have waived coverage, hey, don't give me a penalty because it was affordable based on the federal poverty line, which happens to be code 2G. When the IRS sees this, they'll say Tripp VanderWal, for example, was not enrolled, but Miller Johnson provided him with affordable coverage that was also a minimum value. So we do not assess Miller Johnson with a pay or play penalty on behalf of Tripp VanderWal. The other thing is when the IRS gets that, if I had gone to the exchange to purchase coverage to the exchange and gotten a premium tax credit, the government will realize, hey, Tripp VanderWal was not eligible for a premium tax credit because his employer, Miller Johnson, offered him affordable coverage. So I may have to pay back any of that credit that I have received. Part 3, as you can see, looks very much like 1094-B. And will only be required to be completed by those of you with a self-funded plan. Again, you will list the employee and any covered dependents along with months in which they were enrolled for at least one day. Similar to Section 6055 reporting, the Section 6056 is required annually during the first quarter of the calendar year after the calendar year to which the reporting relates. So that was kind of a mouthful, but again, if I'm reporting for calendar year 2015, the reporting forms are going to be due in the first quarter of 2016. Again, similar to the B series forms under Section 6055, Section 6056 is reported on an entity-by-entity basis if you are in a controlled group. Now again, one entity could prepare these forms on behalf of the other entities, but it has to be done on an entity-by-entity basis. Again, you may engage with a third party to complete this reporting for you, and I suspect many of you are starting or have determined a third party that will assist you in this. Now, keep in mind, if that third party messes this up and the IRS imposes penalties for those inaccuracies, those penalties are still going to be imposed on you as the employer, not your third party. Now, again, in your service agreement, we would recommend that you arrange for indemnification provision, so if it is the third party's fault, they would reimburse you for any penalties assessed to your organization. So as I mentioned when we were talking about page 1 of Form 1094C, that's when we were talking about those 4 different boxes to check: the qualifying offer method, qualifying offer transition method, and 98% offer method. Those are what we call simplified reporting options. And this is kind of a misnomer because, as you will see, we don't really think that these are simplified reporting options. At most, they're what we call simplified distribution options. And these options apply, and so they are no relief from the pay or play penalty. What they do is they're intended to make your reporting obligations offer. So the first one is the qualifying offer method, and it only applies if you as an organization make a qualifying offer. And let me point out, a qualifying offer is more than that's required under the pay or play penalty. But it's what's required if you're going to satisfy this qualify for this simplified reporting. And a qualifying offer is if you offer employee-only coverage, which is affordable based on the federal poverty line safe harbor. You also have to offer coverage to employee spouses and dependents. Now again, the pay or play penalty just says you have to offer coverage that's affordable using any of the safe harbors, and you actually don't have to offer coverage to your employee spouses. But if you want to qualify for this simplified reporting, you need to make sure that it's affordable based on the federal poverty line and that it's offered to employee spouses and dependents. And so what is this if you satisfy this qualifying offer method, what do you get to use? Well, when we talked about completing line 14 on the employee statement, we indicated that you would, for example, indicate code 1E in line 14 if you offered coverage to the employee spouse, and the employee's dependents. Here you could enter code 1A, and then you get to skip reporting the cost of coverage in line 15 because the government will know, hey, you used the federal poverty line safe harbor, so it's affordable no matter how much the employee made, so you don't have to include that cost of coverage in line 15. In my mind, that's kind of like big whoop. That's not that much relief. However, that's part 1 of the relief. Part 2 of the relief says any employee who received a qualifying offer for all 12 months, so this wouldn't apply, for example, if you hired someone mid-year, because they have to receive a qualifying offer for 12 months, rather than giving them a copy of the Form 1095-C, you could provide them with an alternative statement that had identifying information about the employer, contact information about the individual responsible for answering any question about the employer's health plan, and a statement that for all 12 months of the calendar year, the employee and his or her dependents received a qualifying offer of coverage. So, for example, if you had 300 people that received a qualifying offer for all 12 months, you could type this up, you could print out 300 copies, and stuff it in their paycheck envelope, and you will have complied with distributing this form to your employees. Now, that may sound good, but remember, a copy of the Form 1095-C still has to be filed with the IRS. You cannot send the IRS an alternative statement. You have to send them the actual 1094-C. So it will still have to be prepared. This is why I refer to this as a simplified distribution rather than simplified reporting. Please keep in mind that if you have a self-funded plan, you have to comply with Section 6055. And to do that, you complete Part 3 of 1095-C. And because you have that obligation, you can't provide any employee who enrolled in your self-funded plan with an alternative statement. They actually have to receive the actual 1095-C because of the reporting obligation under Section 6055. Again, this is actually more confusing than I think than any benefit that the relief offers. Option number 2 is essentially the same as option number 1 and says if an employer certifies to the IRS by checking box B on 1094-C in line 22 that you offered to at least 95% of your full-time employees a qualifying offer, you're going to satisfy the obligations for this qualifying relief. And again, instead of reporting a 1E on line 14 of the employee's 1095, you can report code 1I. And then you again get to skip reporting the lowest cost monthly premium for self-only coverage on line 15. And again, for employees who received a qualifying offer, and here's the key difference. Even if the employee didn't receive a qualifying offer for all 12 months, you get to provide this alternative statement. So even if you had a full-time employee that received no alternative or no offer of coverage, you can still provide this simplified statement. So it's, again, information about the employer, contact information for someone who can answer questions, and a statement that the employee and his or her dependents may be eligible for a tax credit in 1 or more months of 2015. Now, having said all that, a copy of the Form 1095-C still needs to be filed with the IRS, so you're not going to escape the obligation to prepare that Form 1095-C. And again, similar to the previous qualifying offer method, if you have a self-funded plan, you still have to provide a Form 1095-C to any employee that actually enrolled in your plan to comply with your Section 6055 reporting. The last option is a option that I think will satisfy, that most of you will satisfy. So if you certify, again, by checking box D on line 22 of Form 1094-C, that you offered minimum value coverage to at least 98% of your full-time employees, and this is using any affordability safe harbor, then you qualify for this 98% offer method. And if you qualify for this, you get to skip reporting the total number of full-time employees on page 2 of the 1094-C. And I'm going to take you back a few slides, so I hope I don't make any of you dizzy, but I'm going to go kind of fast because I want to show you what you get to skip. So again, as you remember, this is the Form 1094-C, this is the transmittal. So you can see on line 22 there is a 98% offer method. If you certify that you offer minimum essential coverage that's affordable based on any affordability safe harbor to at least 98% of your full-time employees, you will check box D. And that entitles you to skip column B on this page. So where you see that grade in column, that grade in box, you do not have to report the number of your full-time employees on a month-by-month basis. So yes, that provides some relief, but certainly nothing to jump up and down about, in my opinion. So I'm going to return back to the slide that we were at. So again, I apologize if I'm making any of you dizzy. So we talked about how you can have third parties assist you with complying with these reporting obligations. But if they mess up, any penalty for that failure would be imposed on you. So in 2014, there is a $100 per return penalty for any filing failures. Excuse me, another tongue twister. And that filing failure would be if you just failed to file or if you filed an incorrect return. The bad news is Congress recently passed a bill that included a revenue raiser and increased these penalties to $250 per return. And those returns are capped at $3 million apiece. But as you'll see, the second bullet point on this slide says there's a good faith standard in 2015. And that good faith standard says as long as you made a good faith effort to report, then we will not impose any penalties for inaccuracies in that reporting. Now, I want to point out a few things. If you fail to report this or fail to timely report, this good faith standard will not apply. So it only applies if you timely report and there are mistakes on the actual forms. My colleague Mary Bauman and I were in Washington, D.C. in May at a tax conference, which was attended and presented by many IRS attorneys that were responsible for drafting these regulations. Let me tell you, they were not the most popular people in the room. But they did indicate that the good faith standard is pretty broad and they are pretty lenient. In fact, one comment was made, if you totally bury your head in the sand and don't report, you're going to have a hard time making a case that the good faith standard relief will apply. But anything other than that, we think it would apply. So, again, we have to make an effort to apply, and if we mess up, it appears that we wouldn't have any penalties associated with inaccuracies on these forms. My last point about this is, even though a filing penalty may not be imposed, if there's an underlying pay or play penalty, for example, I failed to offer a full-time employee coverage, and that full-time employee got a premium tax credit on the exchange, that pay or play penalty would still apply. So, what are the next steps that employers need to do, or steps that many of you may have already taken? First, I think you need to identify whether you are in a control group. As we mentioned numerous times through this presentation, if you are in a controlled group, you will need to complete this information on an any-by-any basis, but also include information about those other members of your controlled group. 2, do you qualify for any transition relief? And that's for example, the mid-size employer relief. And if I do, we have to properly fill out those forms and make sure that we not only file the 1094C and 1095Cs with the government, but we still pass out the 1095Cs to our full-time employees, even if we haven't offered them coverage. Keep in mind, if you are a mid-size employer that's relying on that relief and you're not intending to comply with these requirements until 2016, if you fail to file these forms, you are no longer eligible for that relief, and the pay or play penalty will apply retroactively back to January 1, 2015. So that's obviously very bad news. So make sure, if you are on the line and you are a mid-size employer, that you get these forms filed. Determine whether your coverage is of minimum value. And again, I think probably everybody in the line's coverage, if they offer coverage, is of minimum value. And is it affordable? And if it is affordable, what safe harbor are you relying on? Because that information will be required to be reported in line 16 of Form 1095C. If you are sponsoring a self-funded plan and are going to need Social Security numbers, do you have that information? And if you don't, now might be a good time to ask any of your employees already enrolled. And for new employees that will enroll, you may want to ask them upon enrollment. It's also a good time to identify, where is the information coming from that I need to complete this reporting. Obviously, to identify full-time employees, you may need information from payroll, but you may need to access your benefit admin systems for information about whether employees were actually enrolled. Last, are you going to complete these reporting obligations by yourself, or you engage a third party to do so? There are many third parties that are offering services. Some will basically take it over for you, but they are pretty expensive. Other services are more a la carte and basically will require you to provide them the data in some format, and they will prepare the forms and file them on your behalf. With that said, we will move into the question and answer period. You can see on this slide is my contact information. If you have any questions that you would like to answer that either you don't get a chance to on this webinar, or you would like to ask it for any other reason, please feel free to reach out to either myself or to Jim. At this point, we don't have any questions, so I will stay on the line here and see if any trickle in here in the next few minutes. The question is, you mentioned the new forms for filing and how to file them have been released. When will the general public, be able to get a hold of them? That is a great question. And first of all, let me tell you, I am also the general public. So because I have access to them, you do. The easiest way to find them, and I just did it this way myself this morning, is go to Google and just type in draft form 1095-4 or 1094-C or draft 1095-C. The top hit, I believe, it will be those forms, and you will see there is a background stamp that says draft forms not intended for filing. But those, you can use those forms. You can access those forms, and again, the easiest way is by Google. Another question did come in, so they are trickling in. This question is, when defining the size of your company, is it by entity or all entities combined? So what I suspect is this question is getting at a controlled group, and are you subject to the pay or play penalty? If you are in a controlled group, you are looking at all of your entities that are in the controlled group and determining the number of full-time and full-time equivalent employees as though they were one employer. If you have more than 50 full-time and full-time equivalent employees, considering all entities in your controlled group, then you are a large employer, and all of those entities are subject to the pay or play penalty. So let me give you an example. Let's say we have two companies that are completely owned 100% by one individual. Both of those companies are then in a controlled group. If one company employs 1,000 people, but the other company only employs 10, they are looked at together to determine if they are a large employer. In this case, they would clearly be a large employer. But the organization that only has 10 employees, even though only has 10, is still considered a large employer subject to all of these requirements. Both good questions. Is Jim? All right, Jim, I'll let you make the call.
Okay. Another thing, if people are still on there, is Fritz at Basic. They're starting to do some of this forms and help people do their filings and all of that. So I've been talking to Fritz on it to see what kind of cost there's going to be, and he's going to try to get me something worked out in that. So as you know, get more information from Basic, I'll let people know. He's trying to set it up. Maybe you can kind of keep track of that stuff during the year, maybe on some software through Guru and different things like that. So as he gets more on that, I can update, clients and see what I can work out with Fritz on different things. So that's one of the vendors doing it down here in Kalamazoo. So.
Absolutely, and I think just to make a point, especially if you're an employer that has to file more than 250 of these Form 1095-Cs, which means you're required to file them electronically. I think you will need some third party to assist you unless you have the ability. You have your own IT department that's going to set up its own transmission system. And we just had another question come in. It says, the question is, when your staff is considered variable hour employees, how long a look-back period can you use to determine if they are truly full-time? The answer to that question is 12 months. The longest initial measurement period you can have is 12 months. And that initial measurement period must begin either on the employee start date, but can also begin as late as the first day of the month following the employee start date. And I will give you an example here of why I suggest or I recommend that employees start those on the first day of the month following the employee start date. Let's hypothetically say I run an organization that hires a variable hour employee every single day of the year. If I do that, at the end of the year, I am tracking 365 different initial measurement periods. That's quite an administrative feat. Now, instead, if I start a new variable hour employee's initial measurement periods on the first day of the month following, I can still hire a variable hour employee on every day of the calendar year, but I'm only tracking 12 different initial measurement periods. And that's because anybody that's hired in for February, for example, their initial measurement period would start March 1. But again, you can use up to 12 months as an initial measurement period. But you should also be aware that the length of time you use for initial measurement period is tied to what you're using for a standard measurement period to measure all of your ongoing employees. So you can only use a 12-month initial measurement period if you're also using a 12-month standard measurement period.
Wait, no more questions, or?
No more at this point.
Well, if someone else has anything, they can get a hold of me or you. And
absolutely.
So I'd like to thank everybody for listening in, and thank Tripp for doing the webinar. And if you have other questions, obviously get a hold of me or get a hold of Tripp, and we can get them answered for you.
All right. Everybody have a wonderful weekend.
Thanks.
Thank you, Jim.
Well, thank you. Bye-bye.
Bye.